Hi folks, Pat Gage here. I'm from the Block G Group, and in this short video, I'm going to cover the different classes of multifamily apartments. And this can go for multifamily, office, retail, but this is specifically tailored to the multifamily apartment classes. All right, so let's take a look at what we've got here. A little history, right? A little history on what this really is. Investors, lenders, and brokers develop this property classification to make it easier to communicate amongst themselves, right? We got to figure out, okay, what kind of property you get over here based on quality and the rating of the property. All right, so that's what a little history is. That started many, many, many years ago, and it's just a way for people to understand. Hey, I got an A class, or I got a B class, or C class. People understand that, and again, that's part of the language or getting into the communication of investing, right? For investors, property classes is an important factor to consider because each class represents a different level of risk and return. And we'll talk about that here in the next few slides. And that's really what it is, folks. That's the difference. What it is a level of risk and the level of return that you're looking for, okay? So risk and return, right? Each property classification reflects a different type of risk and return because the properties are graded according to a combination of geological and physical characteristics, right? Where the property is located, right? Risk, of a property in downtown Manhattan is probably a lot less than risk in the outer boroughs or on the south side or north side. And no offense to, I don't think about it, but I'm saying is it's the different area location or the physical characteristics. Typically, in an area and we'll get into this, the physical characteristics of the property. If it's a well-traveled, busy market, they're able to update the property, and it's what we call Class A. And I'm getting ahead of myself. That's more desirable, right? The physical characteristics are upkept. The building itself or the structure itself may be 50 years old, but it's upkept very, very well, and we'll cover that in here. So I just wanted to give you a little difference or a little take on what the risk and the return is, and we'll talk about that here coming. Okay, so the letter grades, and it is a letter grade system. It's A, B, and C, just like you're in school. And it doesn't mean bad, good, or whatever. And that's what I'd like to say first off is there is no bad, good, better. Okay, it's just based on again what your risk is, what your returns are. Okay, I know people who are knee deep in C and D class properties and making a fortune, right? And I know on the other side of the coin, I know people who are, making a fortune and killing an A property. So it just doesn't matter. Again, the letter grade is assigned to properties considering a lot of factors, and these are not all inclusive, but these are some of the factors that go into the classifications, right? Again, the age of the property. How old is the property? Typically, newer properties are considered grade A, all right, or class A, and we'll talk about that. The location, right? The location of the property. And nowadays, and I'm filming this in the middle of the pandemic, in the second year of the pandemic. Location, it does bode. It does not as much as it did 2 years ago, but again, it will. Okay, if you have a property that's way out in rural Iowa, and you're not getting the traffic compared to, something in downtown Manhattan, again, the risk and return, folks. Your tenant incomes. What are your tenants making as far as a household income, right? That's taken into consideration. The growth prospects, right? Is it in a growing area, growing city, growing MSA, growing in the metro statistical areas, what MSA is, is the growth prospects for this city, town, county good, right? And we look at that as well. Also, appreciation. Again, goes back to the growth, right? Is the area appreciating or is it depreciating? Is it a Flint, Michigan? We hate to kick on Flint or kick on Detroit, but that's where I'm from. So, those areas are depreciating. Yeah, you can buy properties down there for $5,000, but okay, good luck trying to sell it in a couple of years, right? And again, don't want to dig on, but the amenities at the property. What does the property offer? Pool, spa, parking, valet trash, great dog parks, whatever, or is it just a basic box, with a parking space, right? And also the rents, right? What are the rents in the area? They may offer great amenities, but the rents are low. Well, it probably won't happen that way because one pays for the other. But what are the rents in the area, right? $700 a month is a lot different property than 17, 18, 2,000 a month, right? All right, so let's get into these classes, right? Here's Class A, and I'll just kind of recap. So, what Class A is typically, and again, this is kind of a range here. These properties represent a higher quality of building in the market area. Okay, typically Class A are newer properties, built within the last 15 years, right? These are new construction. These are, 15 years old. The building's barely, coming out of its baby stage, right? And it has a lot of top amenities, right? It's got all the spa, the gym, the valet parking, maybe a concierge, person at the front desk or a doorman. The tenants there earn a high income, right? And again, I'm not using dollar figures because high income and rents are to areas. Okay, what I consider high income may be middle income if you live in California, right? I don't know. So I'm not giving ranges. I'm just saying a higher income tenant base, meaning higher income than the other two classes. Low vacancy rates, right? And what this transitions to is a lower cap rate, okay, which is, again, I'm not going into what a cap rate is on this video, but a cap rate meaning the lower cap rate means a return, right? The returns are lower because the risk is lower, right? It's well located in the market and are typically professionally managed. They're managed by professional property managers that, run these things like a business, which is good, right? Typically demand the highest rents with little or no deferred maintenance. Okay, there's very little things. As soon as something happens, they're fixing it. Right? They're just because they've got the professional manager and also they're making a lot of money on the rents. Okay, so they keep up the building again. Building's only 15 years old, folks. I mean, that's what you got to look at too. Is that there's not much to do in a 15-year-old building, which is great. Okay, so let's take a look at Class B properties, right? And again, I'm using these as ranges. Okay, see these are older properties, typically 15 to 20 years of age. Middle income earning tenants. Okay, they are not the high earners of the Class A. These are middle income or middle class people, right? You know, average vacancies for the area, right? If the area is 5%, 6%, that's okay. That's what that typically is, right? And again, these aren't all hard and fast rules either, folks. These are just guidelines. These are like the bumpers you put up when you're bowling with your kids, right? You just put them up and get the ball down the aisle. May or may not be professionally managed. And when I'm talking about professional managers, a professional company like a CBRE, which is a huge company, it may be a local company that has 5 or 10 properties, okay? It's well maintained, but may have, deferred items, right? May have a few little things that, they haven't really, got it done right. And again, it's not anything huge, not where the building's falling down, but you can see that. Usually not a ton of amenities like Class A, right? They may have a pool, but they may not have a gym. They may not have a dog park. They may not have, all the things that a Class A has. And again, as investors, we look at this, and I've done other videos on this, other things like that, that's an opportunity, right? That's an opportunity for you. If they don't have a dog park, they don't have valet trash, and you, the income and the area can afford to do that, that's an option for you to go in and offer that amenity to the community, and then you add value to that community, hence the value of the property goes up. Okay, these are value add, right? This is when you hear people, investors talk about value add, because these can be upgraded to a B plus or an A plus property, right? And again, I'm being general here. Okay, definitely have value add. You can upgrade, but you got to make sure that that may be a B and an A class area or such, right? And again, there's a little fluidity with that when I say that. But again, there's a value add opportunity of upgrading this. And again, like I just talked about, throwing in a dog park or valet trash, or let's put in a workout center. That may bounce it up right there, just those simple things, right? And typically these have higher cap rates than Class A. Okay, and again, it goes back to that risk and return. You're getting, these buildings are 15 to 20 years old. They will have a little bit more deferred, right? The building starts to age, but again, still desirable area. You can work with that. All right, let's talk about Class C. Now, these are older properties. These are typically more than 20 years, and they're typically in less desirable areas. Okay, the lower income earning tenants, you got your, blue collar and below, service level, and again, not beating this down and not saying it's bad or good. I'm just kind of giving you a general overall definition, so don't spam my email. Okay, so these are Class C. These are workforce housing is typically what it's called. Okay, and again, the lower income, you'll have to determine that for your area. Okay. And typically what I'm trying to do is when you're talking to brokers using this type of language, they'll direct you, right? They'll say, "Oh, what are you in, Class C?" Okay, great. Yeah, this is this area of town, or that's in this area of town. The vacancy rates are, historically a little higher than other classes, okay? Because again, you're getting a little more transient type of population because they earn less. They're always looking for that next good deal. I'm not saying that we all aren't, but that's typically what it is. So the vacancy rates are a little higher than the B and C class, B and A class areas. These are definitely not professionally managed, although that's kind of that's a hard one to say. You wouldn't get a CBRE into these Class Cs. You'll probably get a little smaller, a state, one that does it in a certain state or a county property manager. You won't get these huge companies. But again, I'm again recording this in the pandemic. Things have changed. Multifamily is huge as far as demand. You'll probably see that change. So don't use that as typical. But typically, it's managed, self-managed, or managed by a very small property manager. Rental rates are lower. Or I should say the lowest in the different classes. These will not be the same rental rates as an A or a B class. Okay, and again, in your area, you'll have to figure that out. And then also, this one here also holds highest cap rates among the classes. Okay, because again, that risk and reward, because you're going with lower income tenants, you're doing it with older buildings, you're not in desirable areas. All these things add into less desirable, or I should say a lot higher risk, right? No judgment. There is a Class D. I don't cover that in here, but again, that's the Class D. They do sometimes talk about that, and that would be, you're really not desirable classes, but typically it's A, B, and C. All right. So let's take a look at the summary. Let's get this all together, right, in this short video. And again, this is not made to be a end all be all. This is to give you an idea of some different classes when you start talking. Each class presents a different level of, again, like I said, risk and reward, right? You want to go into a C class because that's a steady cash flow, but you're going to dealing with tenants that may not be very regular. That again, that's all what you look at. Some classes can be sensitive during economic challenging times, right? You get an economic downturn. Let's say the black swan that we just had here with the pandemic, right? Your Class A and Class B may be more affected by that because economic downturn comes, who loses their job first, right? It's typically not, the managers and the higher echelon people in the companies. Now, this black swan that we just kind of went through, it's kind of really the reverse, right? Because of the pandemic, guess what? The service level, the front line, the middle class has been hit harder because their jobs, they just couldn't go in. They couldn't go in and open their restaurants. They couldn't go in and open up their stores, their retail, their small businesses because the government said, hey, we got to shut this pandemic down. So you got to look at that too, right? Class B and C are traded at a higher crap rate than Class A. And again, that's relative to your area. The property class investors should choose to have a great deal of influence on the stability of the investment over time, as well as its growth appreciation. Okay, so depending on what you're looking for, and again, each class offers that risk and reward that you're going to have to talk about and say, okay, what's the risk and reward? Typically, on the management side, Class A are much easier to manage than Class C, right? Your Class C properties are more manager intensive. You're chasing people, you're chasing money, you're chasing, and compared to Class A. And again, it's just that risk and reward. For capital preservation, maybe, investing in Class A is the way to go for it, right? But if you want to do capital appreciation, you can go into B or C, maybe a better risk profile. And again, this is up to you as the investor. What this video has hopefully kind of educated you in is the different classes, how they're classified. And again, this is not an end-all be-all video, right? But this is going to give you a summary of what they are. And the reason when you start hearing cap rates and Class A and Class B, what does that mean? Right? And that's what I'm doing with these videos, is hopefully educating you enough to say when you talking to a broker or hear another investor say, oh, I'm on B class properties or a B plus class properties, I'm this, right? So you can understand that. And I hope that's what this video did for you. Okay. What I'd like to do next is, folks, thank you very much, first of all, for joining and staying with me to the end. And for that, I'm going to reward you with a free report. You can download this at our website at opportunitycreator.com. It's a free report we created about what's the best investment, the stock market or real estate. And I'm assuming since you're, staying here on this video and still with me after these few minutes, you'll guess it's real estate. But again, get the free report. Take advantage of it. There's also in there you can set up a 30-minute call with us to talk over your investments options. Again, we do present opportunities to our community, people who we know, like, and trust. But please go ahead and do that. Please download the report as well. And I really, really look forward to seeing you on the next video, and I hope you enjoyed it. Thank you very much, folks, and we'll see you then.